Well, welcome everyone. It's great to have everyone here. Welcome back to all of our viewers that are joining us again. If you're a new viewer, we're glad to have you here today. We have very special guests with a very interesting topic. The point of the webinar today is very educational based too, to learn about some investment opportunities that are out there and the mechanics behind it. So as a reminder, today's topic is the alternative investment opportunities in the changing landscape. So without further ado, let me introduce our two guest speakers. We have Kaaren Hall, founder, CEO of Untitled Services. Thank you so much for joining. How are you?
Thanks, Mike. Doing great. Appreciate it.
Fantastic. And we have TJ Coveyu. TJ is the founding partner of Newport Realty Trust and the co-founder of Newport Private Group, where he currently serves as the president and CEO. He founded and is currently running Arch Loans and Newport Commercial Capital, the two lending subsidiaries of Newport Realty Trust. TJ, welcome.
Good morning, everybody. I think it's probably morning for most of everybody here. Thank you.
I'd have to say we have, two great speakers, very well accomplished, feeling like a very unachiever today. But anyways, happy to have both of you. It's going to be phenomenal. We have some really great questions. Let me introduce myself for those of you that don't know me. My name is Mike Blumikranz. I'm head of all loan origination with Arch Loans and Newport Commercial Capital. And, typically people or borrowers are borrowing with us because their current lenders are just having them jump through these hoops where they have these underwriting processes that are, a lot of paperwork or full appraisals that are necessary. So here's what we do, and here's how we can help. We offer up to 100% financing on the purchase price. We can underwrite a deal with a drive-by appraisal, and we do offer up to 100% financing on improvement capital for those type of deals that have a large improvement capital needs to it. So without further ado, let's jump into our questions. Again, the changing landscape and alternative investment opportunities that we have. So Kaaren, question that we have for you, are self-directed IRAs new?
No, they're not. And they're specifically for alternative assets, as you mentioned. But no, you've been able to self-directed IRA ever since IRAs came into existence. And that was in 1975 when the ERISA laws went into effect. So if you want to Google that, it's the Employment, Retirement, Income, and Security Act, the ERISA Act, that Gerald Ford signed into effect. So yeah, 45 years you've been able to self-direct, but it's been a best kept secret for a lot of years. And even still, a lot of people don't know about this. Even attorneys and CPAs are not all familiar with this. But it's been around for a very long time.
Oh, very interesting.
Yeah.
And TJ, how does private lending fit in with an IRA?
Well, first of all, I want to just caveat, I'm not an attorney, an investment advisor, or I don't have any fancy initials after my name. So I can really only speak from experience. And also just welcome everybody here. I'm glad you're spending your time with us. Lending can work in an IRA very well because it's a relatively simple structure, and the IRA custodians sometimes have to worry about a lot of strange tax things and other compliance things that I think Kaaren will probably talk about a little bit later. But as it relates to trust deeds, they're a very simple thing to get your arms around. Also, they provide steady income. And strategically, what I've seen in my experience is that real estate investors who know real estate, who feel comfortable with real estate, who want to have a high exposure to real estate in terms of their overall net worth, have this money tied up in an IRA. And if they're in a traditional IRA, they can only really buy securities with it. And they want to put it in real estate. Well, Kaaren will talk a little bit later, but they can't put it in their own. They can't put it in their own business. So having them being able to lend, finding a structure where they can lend their money out through their IRA into an asset that they can feel comfortable with is really a great fit for a lot of people. And in our experience, in terms of the clients we work with, that's a very high number of our clients. It also provides diversification if you happen to be investing in a portfolio. And another thing that's kind of a subjective, kind of soft side to it is that if you are a real estate investor and you're active in the market, you have some more capital with which you can create partnerships. So many of us may know that, you know, the best way to get to know somebody for a long-term partnership is to do a deal with them. Well, this gives you some capital with, you know, you can help somebody out, you can build a relationship, and then later on that relationship can grow. And so it's kind of neat to have that extra capital to do that. If you buy Apple stock, it doesn't mean you're going to get a relationship with Steve Jobs, but you know, you can do that in this case. So yeah, and there's a follow-up to that is, you know, at what point is my IRA big enough for me to do this? There's various ways to do that and still stay diversified, which, you know, we can talk about later.
Yeah, that's a very popular question too, is what if my IRA is not yet big enough? And so Kaaren, what are the self-directed IRA rules?
Yeah, TJ was just, you know, touching on that a little bit, so I'll get into it. So with self-directed IRAs, they have some unusual rules that don't exist elsewhere in investing that I'm aware of, and they're called, well, let's put it this way: you want to keep away from prohibited transactions. So a prohibited transaction is doing business, for example, with somebody who's a disallowed party. So we'll talk about that. People who are disallowed to your IRA are your lineal ascendants and descendants, like up and down the family tree. So that's your parents, grandparents, you and your spouse, your children, your grandchildren, and their spouses can't benefit from the IRA. No personal benefit, no present benefit, you know, that sort of thing. So not benefiting today from the IRA. It's all for retirement purposes. But other disallowed parties could be a fiduciary. For example, your IRA isn't going to invest in a project that your CPA is in. That sort of fiduciaries are disallowed. And also a 50-50 business partner is also a disallowed party. But the parties that are allowed are out to the sides on the family tree, like your brothers and sisters, your nieces and nephews, aunts and uncles. So, for example, your IRA would not invest in a property your parents own. Your IRA would not sell an IRA-owned property to your children. That would be a prohibited transaction. The IRA never buys, sells, or exchanges or trades between the plan, the IRA plan, or the solo 401k plan, and any of these people. All right. Another thing, and by the way, you can look this up if you want to read the rules. It's the Internal Revenue Code 4975. Just whip out your Internal Revenue Code book you probably have sitting there and pull up IRC 4975. But that's where it's written. But it says that you can't provide goods, services, or facilities to the plan if you're disallowed. So what does that mean? It means, for example, we had one gentleman whose IRA was going to buy a property. So we take a look and we're looking at the documentation and we see his last name. And then we go and we take a look and we see, wait a minute, the broker's got the same last name. So we ask our account holder, who's the broker? And he says, oh, that's my dad. Well, that's a prohibited transaction because it's a disallowed person, a father, right, a lineal ascendant, providing services to the plan by acting as a broker. But additionally, this disallowed person wanted to receive benefit. He wanted to get a commission for it too. So those are two prohibited transactions. So I say prohibited transactions, and it doesn't sound that serious, does it? It's just like, oh, you're just going to get a little slap on the wrist. It's just prohibited, but no, it's a big deal. What happens if your IRA has been deemed to have committed a prohibited transaction is the IRA blows up and it's no longer an IRA. It's now your personal money. And so you get 1099 for the balance of your entire account, and there probably will be penalties, excise taxes, that sort of thing on top of it. So the self-directed IRA game is a game of keep away from prohibited transactions. And as you mentioned, when you're investing in notes, since we're talking about that asset class, again, just like TJ, I'm not an investment advisor. I don't give investment advice, but I can talk about self-directed IRAs. So when an IRA invests in a note, as long as the borrower isn't a disallowed party, you're okay. And as long as the note doesn't benefit the disallowed party, then you're okay.
Interesting. I appreciate how specific you were on the exact code that we have here. So to the viewers as well, we will have a quiz at the end, and I believe that was 4975. So interesting. TJ, what is the difference between an individual trustee versus a portfolio of trustees?
Yeah, that's a good question. So within your IRA, let's say you have $250,000 that you want to allocate towards trustees or real estate debt. One option, and this could make sense in a lot of cases, one option is to go out yourself and go lend the money directly to an individual or an entity or some kind of real estate investor, and you can do that. Some of the advantages of doing that are that you get to know the deal very, very intimately. You get to negotiate the deal specifically. You can do some unique things like maybe do a second trust deed. And also you can build a relationship with that person if that's part of your goal. So there's some real advantages to that. You can probably get a higher yield, nominal yield, while the money is out too when you do that. And many, many people do that. I do that personally, actually. There's some significant risks with that. If you're not a real estate investor, you're not proficient at underwriting these things. Loan docs have to be generated. You have to hire somebody to do loan docs. You know, you're taking on a lot of risk yourself. The other inefficiency is that you're only earning money when you put the money out. And if you have $250,000 and you put it out and then it comes back, it doesn't make any money when it's cash. Diversification is a serious problem. So there's some reasons you might do that, but to solve some of the downsides of it, another option would be to invest in a loan portfolio. And they're structured various ways, and I think there's a question later in the session about the structuring. And I'm sure Kaaren would prefer certain structures to others, but generally speaking, if you do something like this, then you put that $250,000 across many, many, many loans, maybe 100 loans or maybe 200 loans. It just depends on what portfolio you sign up for. You may see some lower yields on a per day basis because there's fiduciary costs, there's management costs, there's all those types of things. But typically when you invest in a portfolio like that, your money starts earning the day you invest. So overall, your yields may not be any lower. The other thing is that the time that you're spending is significantly less. It can really be a passive investment. But the biggest advantage to doing a portfolio versus an individual trustee is that you've got diversification across so many loans that you're not relying upon any one loan or any one set of loans to bring you that income and protect your capital. So it's a very good question. It's very strategic. It's about what the objective of the investor really is, but their eyes should be open about the benefits and the risks of both.
Okay. And Kaaren, to touch on this topic, can my IRA lend money?
Right, yeah, an IRA absolutely can lend money. It's one of the asset classes. Your IRA can do lots of things, invest in real estate and private stock. It can buy performing and non-performing debt. It can also be the bank and lend money, absolutely. And to do that, it's a three-step process. You get the account open. Once the account is open, then you fund it either through an IRA to IRA transfer, for example. You could do in a rollover of a previous employer plan, or you can write a check and make a contribution. So you open the account, you get it funded, and then the IRA is the lender, and that's how it should be written on the document. And we review it, and assuming the vesting is correct and the IRA is receiving an asset in exchange for the money, then it's funded, and then all the note payments are made back to the IRA that owns the asset. It works like that.
Okay, and also Kaaren, can my IRA, can it borrow money? A back and forth transaction here.
Right, that's a different thing. So it's a big misconception. People will think that an IRA can go out and get it like a conventional conforming Freddie Fannie kind of a loan, and it cannot. An IRA can only take on non-recourse debt. I do have a list of non-recourse lenders if anyone would like that. You can email me, info@udirectira.com. I'd be happy to shoot that out to you. But a loan to an IRA must be non-recourse. And so what that means is that, A, it's debt that the lender can only come against the subject property and not against any other assets within the plan, okay? This loan's not about your FICO score. not about how much you earn. It's not about you. It's strictly about the property's location and condition, but primarily they're underwriting for cash flow. So an IRA can be the bank. The IRA can also borrow money. But when the IRA borrows money with a non-recourse loan, keep in mind, it can throw off a tax. And that tax is called Unrelated Debt Financed Income Tax, UDFI. If you want to write down another chapter and verse here, it's irs.gov, the website, publication 598, to learn more about the tax that your IRA may incur if the IRA takes on non-recourse debt.
Okay, thank you for that. And again, we have a quiz at the end of this with here. So TJ, what are the common structures for portfolios?
Yeah, there's three common structures I can kind of think of off the top of my head. In our case, we're a REIT. Newport Realty Trust is a REIT. I think for IRA investing, I think that that's probably the best structure. So a REIT is a C corporation that sells shares to its investors. So as the IRA investor, you're buying shares. And then that C corporation holds real estate assets. In the case of what we're talking about, it would be holding notes secured by real estate. REITs have quite a bit of hurdles they have to get through in order to be qualified as a REIT. So there's a lot more fiduciary attention spent on the entity. For example, REITs need to have quarterly audits by a third-party CPA to make sure that the income coming in is real estate related, to make sure that the balance sheet is real estate related, make sure that there's not a concentrated shareholding. So there has to be a diversified shareholding. There has to be at least 100 shareholders, and the top 5 can't own 50%. So that protects, of course, the lesser shareholders. There's quite a bit that has to happen, and a lot of third-party looks at REITs. So from a fiduciary perspective, and from the perspective that it's a C corp that sells shares, my experience with IRA custodians is that they far prefer a REIT to any of the other structures.
And Kaaren, how long does it take for my self-directed IRA to fund a deal?
It doesn't take very long. But one thing, though, is to set up the IRA first and then get it funded so that you're able to basically execute when you find a deal. Funding it, if it's a transfer, can take, I'd say up to 2 weeks at the most, a transfer or rollover. And same thing with a contribution, at the most 2 weeks, usually a week. So if you've got an account that's open and funded, you give us a deal, we're going to review it. And typically within 24, 48 hours, we have that deal funded. And then 100% of the proceeds come back to the IRA that owns the asset. Expenses, since we're talking about notes today, any expenses of the asset are paid for by the IRA, not by you personally, but by the IRA.
And TJ, with our topic that we have of alternative investment opportunities, and with this changing landscape, what are the key risk factors about this market?
There's a couple things going on. So let me talk about risk factors just in general, and then I can talk about them kind of post-COVID. But in general, if you're going to invest in individual trustees, you really need to know what you're doing, because you're really concentrating your capital in one thing. So if you're not a professional real estate investor, if you don't have the experience, if something goes wrong, to be able to figure out how to work through that, you really want to take care about that. I mean, there's things that can, we've done thousands of loans, and I could tell you thousands of different war stories. In general, the other thing is that if you invest in a portfolio, you want to make sure that the portfolio managers are very experienced, that the portfolio has the diversification that you want, that the leverage is low enough. The leverage on the loans that they're making is something you're comfortable with for the rates you're getting. But also, REITs and other portfolios can lever themselves. And some of the publicly traded REITs are levered at 10 times or more, which means for every dollar you put in, they go borrow another $9. And that's very, very risky. You can get higher inflation that you're in terms of that. And that's kind of getting me to the post-COVID scenario. So we probably all know that the real estate market has not fallen off a cliff. Part of it is there's a lot of reasons for it. I think the main reason that in California it's been so robust is that supply is so constrained. It's just very, very constrained, but there's all low interest rates, people wanting to move from urban areas into suburban areas, where there's a lot of suburban areas in California. And also there's this, the real estate market doesn't move that fast either. I mean, I say that, but in 2008 when it stopped, but it really is not going to move on the wall. So there's time for everybody to sit back and respond to things instead of react to things. So the underlying assets haven't gone down. In fact, in many areas, they've gone up. Now, there are types of assets that are struggling, like hotels and maybe office building. I think the debate is still ongoing there because those leases are sold. And more importantly, has been the capital structure of who you invest in. So if you're going to invest in a single trustee, that's pretty simple. You want to know the liquidity of your borrower, and you want to know, the liquidity of the property, and that's relatively simple to get your arms around. If you're investing in a portfolio, there's different types of portfolios. They're leveraging a lot, they're borrowing a lot, and then what they're doing is they're originating loans and then selling them on to a secondary market at Wall Street. Well, when the pandemic happened, that secondary market stopped. So those lenders weren't able to sell the loans that they made, which means they couldn't get the cash to make new loans, and their business is based early. But it does mean that they couldn't operate until they were able to get their liquidity going again. So that's something to think about. And then publicly traded REITs, which if you're doing publicly traded REITs, you're probably not so concerned about a self-directed IRA anyway, but the emotions of the public markets, and that can become problematic. The other type of REIT, which is what we are, but there's others out there, is what's called a balance sheet lender. So we have our own long-term capital, and we keep all of our notes on our books, and we service all of our notes. It's harder to grow when you're using all your own money. When things change, the dynamics change in the capital markets, those types of lenders can just keep churning. And that's what's happened in the COVID area, is that some lenders had to stop lending and others were able to keep churning and keep going. And the ones that kept going were able to improve their balance and got continuously stronger. So there's a lot of moving parts. And I think the lesson is just be familiar with what you're investing in. And if you're going to invest with third parties, make sure you're comfortable with their fiduciary discipline and judgment.
Very wise and very good advice. And Kaaren, what should I watch out for? And I meaning, what should, generally speaking,
with IRAs,
watch
self-directed IRAs? We want to steer clear of prohibited transactions like we were talking about a minute ago. When an IRA invests in an asset that goes bad, say for example, a note and the borrower just doesn't pay and now it's a dead, it's a toxic asset. Well, in that can't work. What we need is a valuation from a third-party valuator telling us the value. So we don't value because we're not fiduciaries, we're not official valuators. So we get a third-party valuation, then we can write it down. And then we can disperse whatever remains in your account to you at that time, and then issue the 1099s and 5498s and whatever we issue at that point. So that's what you want, a toxic asset in your IRA. You don't get to write off that loss. So it's really precious money. There's so many ways to do due diligence, especially on notes. Like talk to other people that have invested with the asset sponsor of public records, and make sure if your IRA is investing in a note on a piece of property, secured property, look at the title report. Pull up a preliminary title report. Does the person selling it have the right to do your due diligence? Extremely important because retirement money is precious money, so you want to make sure you make a wise investment decision.
And so Kaaren, one other question for you is, do you offer opportunities to match up IRA clients with available real estate offerings?
No, but we are not advisory. We sell nothing. We sell which is to say we sell no assets. We're not advisory. We don't sell anything. Okay. I mean, asset self-directed, and the self part of self-directed means you go out and choose the asset yourself. It's not one that we tell you about. It's something like when you buy a house and you go through escrow, the escrow officer doesn't tell you which house to buy or a bad idea. You just tell the escrow officer, I'm buying this house, and they administrate the paperwork. That's what we do. We administrate the self-directed IRA transaction. So no.
And TJ, can you refer an IRA custodian if an investor wants to hold an investment in his or her IRA?
I have sort of the same answer as Kaaren, but a little bit in the reverse. So including UDirect, there's a number of IRA custodians whom we have investors who have IRAs with, I suppose is the best way to say it. And so we can give people a list of custodians to contact, and each custodian has its own fit and its own community and its own of a few that we know they've already done the diligence on the compliance portion of our investment. So the IRA custodian is not going to tell you whether it's a fraud. They're not going to tell you whether it's a good or a bad investment, whether it's good or bad for your portfolio, but they have to do a check to clients. And so we do have a number of custodians who have already done that check, so they don't have to do it, and we can make referrals out that way. It's more common for us to have an existing shareholder that says, hey, I'm an existing shareholder with my normal money, but I've got this, I'm going to pick on Charles Schwab IRA, and it's not to a custodian, and we can certainly do that, but we'll give them multiple choices because we're not picking custodians.
And so we're now back to our final question here, which I have for each of you, and we'll start with Kaaren. And this is more of just kind of in your, with the services that you provide and in your opinion.
Yes, that is the question, isn't it? I guess a lot depends on what happens on November 4th. I listen to a lot of economists, and I'm not one myself, but I don't even play one on TV, so I can't, assume to have that information. But everyone says that we're expecting a down season. including corporate debt and so forth. So we'll see how it rolls. I mean, at some point, it's going to go up, then it's going to go down, and we can be sure of that.
Oh, okay. Can I get out of this question? No. You know, there's a lot of upward pressure right now in the real estate market, and that's nice for now. But I do think that next year is going to be a tough year overall for the economy. Not every recession hits real estate that dramatically. I don't think we're going to have any. I think corporate debt is pretty scary. I think there's some consumer debt that's pretty scary, although you could argue that the government could just forgive the consumer debt. So I'm not giving a straight answer, but as we underwrite loans, if they're not office, not retail, and not hotel, which means if they're multifamily, if they're single family, if are strong, and they'll continue to be strong simply because of supply pressure. It's so hard right now to build new units. Construction costs are skyrocketing because of the COVID's probably a big factor, I'm going to assume. And so to replace those units, we're in the California markets, we're in Colorado, we're in some of the more supply constrained markets, but I feel good. That being said, if consumer sentiment overall is negative next year, which could happen if stock portfolios drop by a large percentage, then there's going to be, you know, some softness and more careful and less speculative.
Great.
But my bottom line is when we underwrite a property that's going to, let's say we need to know what the value is going to be in a year, we don't take it down 30% or 40%. We take it down.
Well, I want to thank each of us today. Thank you, Kaaren, and thank you, TJ. Again, to our viewers, we will send out a follow-up email with contact info. So if you do have any specific questions we did not get to, please reach out to each of our guest speakers. If you do have any questions for myself as well, feel free to reach out. Any final thoughts from TJ, from Kaaren?
Well, I'll take that ball and run with it there. I think we all need to save for retirement. I think take that away from this event today. Very few people are really truly prepared for retirement. Like if you had $100,000 and you thought, well, that sounds good, and you're going to retire at 59 and a half and live till you're 86 and a half, and you do the math, assuming no gain or loss, you're going to have less than $400 a month to live on. So you need to save for retirement. And one way to do that is to self-directed IRA and invest in alternative assets like notes and real estate and precious metals and private stock. And this is another way to build that nest egg so that you have a more comfortable retirement. So the takeaway from today is definitely do yourself a favor, pay yourself today, write a check and contribute to your retirement account, whatever it may be. And maybe it's tax deductible. Maybe you get a tax break for that, even better. That's my takeaway.
Thank you. And TJ, any final thoughts?
Thanks for doing this. You did a great job, and I appreciate you hosting and setting this up. Thank you.
All right. Well, thanks everyone for joining. Thanks to our viewers for joining us today. We'll see you next time.